Public markets function as a dense, interconnected grid where the financial performance of one sector often dictates the stability of another. As the world's largest asset manager, BlackRock held $11.6 trillion in assets at the end of 2024, providing a massive footprint across these global systems. In Q2 2025, BlackRock evaluated over 100,000 proposals, funneling them into two outcomes. Under a fiduciary mandate, they support management in 90% of votes. The remaining 10% represents active dissent, concentrated in core governance, company impacts on people, and climate. At this scale, a 10% dissent rate means BlackRock voted against management at over 870 companies in a single 3-month period. Proxy voting on environmental issues is often framed by external observers as a form of social activism or ideological preference. The voting data shows a different driver. A vote against management is triggered when corporate leadership fails to disclose or manage a material financial risk to the business. The Q2 2025 statistics identify the specific governance gaps and reporting failures that lead to these penalties. In this context, sustainability is treated as a component of enterprise risk management, focused on the long-term financial resilience of the portfolio. One primary cause for dissent found in the data is a conflict between a company's long-term targets and its current operational trajectory. Many corporate boards set distant milestones, such as reaching net zero by 2050, to address broad stakeholder expectations. This chart visualizes the disconnect. While the projected target line trends downward toward 2050, the company's actual energy or emissions intensity is moving in the opposite direction. Kingboard, a Hong Kong-based chemical manufacturer, provides a specific example. Despite citing national carbon reduction goals, the company reported a year-over-year increase in total emissions. A similar gap appeared at SMPC in the Philippines. Their climate roadmap was undermined by a reported increase in both energy intensity and Scope 1 emissions. Both companies acknowledged local climate initiatives in their reports, but both demonstrated short-term performance that contradicted their long-term stated goals. A single-year increase in emissions is not, by itself, an automatic trigger for a vote against management. The penalty was applied because the companies failed to disclose the rationale for the increase, a projected future trajectory, or any capital mitigation efforts. Setting a target without providing an operational roadmap creates unquantifiable financial exposure, which institutional investors view as a failure of oversight. The Q2 data highlights how institutional capital prices localized